Gold reached a historic peak of $5,600 per ounce in January 2026. Then, the Iran conflict began. Strikes started on February 28th. The Strait of Hormuz was shut down. Oil prices surged beyond $19 per barrel. Under normal market logic, that kind of disruption should have pushed gold dramatically higher. Instead, the opposite happened. Since the opening strikes, gold has lost nearly $1,000 per ounce. It is now trading close to $4,500. That represents a 17% decline. This happened during wartime, during an energy shock, during the highest inflation reading in 4 years. And now, while this is unfolding, negotiations for peace are developing in real time. Trump stated on Saturday that a memorandum of understanding was, quote, largely negotiated subject to finalization. Iran's foreign ministry confirmed Phase 1. The strait may reopen within days. That raises the question almost nobody is discussing. If gold declined during the conflict, what happens once the conflict ends? The answer is not what most people expect. And the reason behind it is not the explanation most investors have heard. The pattern came first. Iran carried out its first attacks on February 28th. Gold had already been rising before the missiles launched, but within 48 hours of the strikes, investors saw gold retreat, while crude oil climbed toward its highest level since 2022. In March, Iran threatened a complete closure of the strait. The crisis intensified. Bond markets reacted sharply. Gold declined again. Later in March, Trump hinted that negotiations could begin. Gold immediately rebounded by 2% in a single trading session, recovering toward $4,550. Then the talks collapsed. A 45-day ceasefire proposal failed. Oil prices jumped again. Gold moved lower once more. On April 8th, Pakistan brokered a 2-week ceasefire. Iran agreed to allow ships to move through the strait. Crude oil dropped 16% in one session. Gold climbed back above $4,790. 5 separate turning points showed the same pattern. Every escalation in the war pushed gold downward. Every indication of possible peace sent gold upward. Morgan Stanley identified the trend. The firm released a note describing it as, quote, signs of safe haven status faltering. Forbes referred to the movement as unusual. WisdomTree tracked what it called the sharpest drawdown since 2013. Major financial institutions recognized the pattern. Very few explained the mechanism underneath it. The simple explanation says the dollar strengthened during the conflict. Oil shocks increased demand for dollars. A stronger dollar makes gold more expensive in other currencies. As a result, foreign buyers reduce purchases. Demand weakens. Prices fall. That explanation is not incorrect, but it is incomplete. And incomplete explanations are how investors lose money. Because the movement in the dollar is only a symptom. The deeper mechanism driving the shift goes further than that. And it connects directly to something already sitting inside retirement accounts across the country. Whether people realize it or not, gold is not only in competition with stocks or crude oil. Its real rival is the bond market, especially the real yield on United States treasuries. Real yield is calculated by subtracting inflation from bond returns. What remains after inflation erodes purchasing power is the figure that influences gold more than almost any other factor. When real yields move below zero, when inflation rises faster than treasury payments, gold becomes attractive. In that environment, it serves as the asset most capable of protecting purchasing power. Large institutions move capital into it. When real yields turn positive, the case for gold weakens. A bond paying more than inflation is delivering a genuine return. Gold offers no interest. A 30-year treasury yielding 5% in an economy with 3% inflation produces a real gain. Gold cannot compete with that structure. Now look at what the Iran conflict did to this equation. Iran launched strikes. Oil climbed beyond $109. Energy inflation accelerated across the broader economy. Bond investors reacted immediately. Markets began pricing in the possibility that inflation would not fade quickly. Investors sold treasuries. As bond prices declined, yields increased. Last week, the yield on the 30-year United States Treasury reached 5.2%. CNN confirmed the figure. It marked the highest level since 2007, 19 years ago. The last time yields were this high, the iPhone had not yet been released. At those yield levels, with inflation near current ranges, real yields shifted back into positive territory. Institutional capital, the trillion-dollar category of money, rotated out of gold and into treasuries. That shift did not happen because investors were unconcerned about the conflict. They were concerned. But instead of expressing fear through gold, they moved into the dollar and higher-yielding bonds. That was the mechanism driving the market throughout the escalation phase of the war, hidden beneath the headlines. Now, the peace agreement changes that mechanism. Hormuz reopens. Brent crude retreats toward $80, potentially lower. The inflation surge driven by oil begins to ease. Bond investors start seeing inflation expectations move downward. The Federal Reserve gains room to consider cutting rates again. When rate cuts arrive, real yields decline. And when real yields decline, the case for gold strengthens again. That is the same direction markets began pricing after the ceasefire agreement in April. Gold rebounded from $4,500 to above $4,700. Institutions remain optimistic on gold. A Reuters survey involving 31 analysts projected an average year-end 2026 gold price target of $4,916 per ounce. But the peace agreement leaves two major issues unresolved. And the bond market already understands that reality. The first problem is the nuclear issue. It remains in Phase 2, not Phase 1. Phase 1 reopens Hormuz. Phase 1 delivers the ceasefire. Iran's enrichment program, the central issue behind the conflict itself, is scheduled for negotiations during a second phase. There is no confirmed timeline. There is also no enforcement mechanism. Trump described the agreement as largely negotiated. Iran's foreign ministry gave confirmation. Iran's parliament still has not approved anything. That is not a finalized peace agreement. It is a temporary halt with documents still unresolved. Bond markets interpret pauses very differently from permanent resolutions. And there is a second issue. The yield on the 30-year Treasury is not driven only by Iran. Oil prices can decline. Hormuz can reopen. Inflation forecasts can cool. But the United States' national debt remains. America is operating with a $2 trillion yearly deficit. For 18 straight months, the bond market has been signaling the same concern. Investors do not believe the federal government can maintain this debt burden at current rates without eventually reducing its value through inflation. That is why the 30-year yield continues moving toward levels that historically create financial stress. A Middle East agreement does not erase a $36 trillion debt problem. The April 8th ceasefire already demonstrated that reality. Yields eased for a short period after oil prices dropped. Then fiscal concerns returned to the forefront. The 30-year Treasury yield did not fall back to 4%. It remained elevated. Because the bond market is not only evaluating Iran, it is also evaluating the balance sheet of the United States itself. That leads to the central question. How much of gold's next movement comes from Iran unwinding? And how much comes from the broader structural story already unfolding inside the bond market before the first missile was launched? Most financial commentary completely missed that distinction. They recognized the anomaly. They described the pattern. They called it unusual. Then they moved on. Meanwhile, the real yield transmission mechanism continued operating quietly beneath every headline tied to Iran. And it is still operating now. If investors want to stay ahead of the next move instead of reacting after the fact, this is the analysis that matters. Not the headline itself, but the structure underneath it. Watch the 30-year Treasury yield this week. Not Brent crude, not shipping updates from Hormuz. The bond market will reveal whether this agreement is genuine or whether the same cycle is repeating again. Threat, pause, reversal. That pattern has appeared 6 separate times since February. And while attention stayed focused on Iran, central banks across Asia were doing something else with their gold reserves during the last 60 days. A different accumulation process was unfolding quietly and systematically, moving at a pace not seen since the post-2022 repatriation wave. Stay alert, follow the bond market closely, and keep watching how central banks position themselves as the next phase develops. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.